Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and today I'm glad to be joined by Ivan Poon, the CEO of Switchio. Ivan, thanks so much for joining me.
Hi, it's great to be here.
Ivan, so first, start us off. What is Switchio and how does it work?
Well, Switchio is a cross-chain DEX. It's a decentralized exchange that I think it's really unique and probably like a world first, where we have a decentralized exchange on multiple blockchains. So how we do it is by developing smart contracts on various platforms, on the various blockchains, Neo, Ethereum, EOS. And then besides just trading it on each individual chain, we actually support swapping them across chains through this technology known as atomic swaps. So that's what we have today. Going forward, we have even more, much greater plans for that through a layer 2 sidechain scaling solution. And in fact, just this week, we have launched the mainnet for that. And over the next few weeks, we hope to roll out this cross-chain trading that's going to be really, really scalable, really, really fast. And I think that's going to be one of the first in the world as well.
Mm-hmm. Now, in this cross-chain trading, what chains right now is supported by Switchio?
So right now we are on Ethereum, Neo, and EOS. When the Trade Hub launch, we hope to also support Zilliqa and Bitcoin. So once this new scaling technology goes fully live, I think it will be really, really quick and easy for us to add a lot more chains. So in fact, with Trade Hub, we are already connected with Ontology because they are supporting the gateway that we are using currently.
Mm-hmm. Historically, historically in this field is very short. In 10 years, Bitcoin's been around, but historically, people turn to these big centralized exchanges to when they want to trade their cryptocurrencies. And it's kind of weird because it's a decentralized cryptocurrency and you're taking it to centralized exchanges. What's the advantage of using a DEX over a centralized exchange?
Yeah, so I think the primary driving force behind DEXs right now is the privacy and the ease of onboarding. So with a DEX, basically, if you're already using, say, Ethereum or Neo or EOS, let's say, with a DEX, you don't actually, it's actually way faster than trading on a centralized exchange. So for example, you go to Uniswap, you key in your trade and hit enter. And that's basically it. Once your transaction confirms, that's the trade. There's no KYC involved. There's no sign up. There's no email, and the security level is basically at the same level as as the blockchain itself. Assuming so the caveat, of course, is that you got to make sure that the smart contracts that you're interacting with are audited, they're safe, many people are using them. Yeah, so I think that's the first main advantage of decentralized exchanges. Secondly, of course, is the counterparty risk. There's no counterparty risk when trading on decentralized exchanges. Everything is controlled by the smart contract, by the blockchain. Like I said before, as long as you make sure that you're on a well-known contract, it's way safer than trading on centralized exchange. So I think that the third, and I think recently the more important thing that has been going on, it's about composability. And trading on a DEX allows you to do many interesting things, basically. So recently we have seen a lot of new DeFi products that combine lending, trading, swapping, liquidity pools, and this sort of composability, like basically building blocks, financial building blocks, has garnered a lot of interest from the community.
Well, we're definitely going to dive into DeFi, real soon. But first, before we get there, it drives me crazy. Why would somebody use a centralized exchange when like you mentioned, the DEX has a shorter onboarding, it's quicker, many times cheaper, and you don't have this counterparty trust issue? Why would people still use a centralized exchange?
Yeah, so I think at least in the past few years, one of the main problems with decentralized exchanges was that was whatever I mentioned previously, like many of the major assets that people are trading, say Bitcoin and new up and coming blockchains, layer one blockchains, weren't actually supported by DEXs, because when you build a DEX, you build it on generally one blockchain, or in our case, a couple of blockchains. So that's a big hurdle for a lot of users. I think another reason could have been in terms of usability. So the Web3 requires the user to actually have some knowledge about how to manage a wallet, how to interact with, say, the browser extension like MetaMask. But I think that has improved a lot with technologies that appeared in recent months or recent years, including like Wallet Connect, where you can immediately trade on the DEX through your mobile wallet. And I think that's one of the supporting reasons why people are now moving away from CEXs to decentralized exchanges as well. Yeah.
Mm-hmm. Well, I think that's a really important point where historically with the decentralized exchanges, while they've been quicker and many times technically superior to a central exchange, there is a bit of a barrier of entry. It does require some knowledge about how to interact with it because you do not have that help of the central party there. Do you think that DEXs have come far enough where, you know, not only the early adopter could use it, but it's easy enough, the UI, the UX is there that even, you know, someone new to crypto, someone who just bought Bitcoin because of FOMO could even use a DEX?
Yeah, I think we are getting really close. I think we like to pride ourselves at Switchio that we have one of the best UXs out there. We even do things where we do a sort of shared custody, where users can use their email to log up and sign up for a wallet. And new wallet services like Portis, Formatic has also improved this by a lot. I think going forward, the main leap that we can make is really to make cross-chain UX easy in a decentralized way, and that's what I think a lot of projects, including us, are working very hard at. And yeah, the upcoming months will be very interesting for that. I think we are at a point where a lot of these developments, a lot of this R&D are almost ready for production.
Mm-hmm. You know, we keep on talking about, you know, cross-chain interoperability and trading. Why is it so important, you know, in the current state of crypto, to have that cross-chain trading ability and atomic swap trading ability?
Yeah, so I think that one of the key reasons, at least right now, is that Ethereum is getting pretty much congested, and the gas prices are really high. So I think previously the main motivation for having cross-chain trading was that there was a lot of interest in other layer one blockchains. But now I think the cross-chain sort of technologies are important, because we don't actually know when Ethereum will reach 2.0 with sharding and scaling and solving all these issues. So being able to, first of all, use other more scalable technologies, say Zilliqa, Solana, or even a custom build like a Cosmos sidechain like us, that's very important to keep the scalability going. And the way to do this, of course, is to combine them with systems such as rollups or fraud proofs, which actually are a method of batching. I mean, simply put, is to batch transactions on the layer one blockchain. Yeah. So so being able to move fraud between chains and onto side chains, this is it's very critical going forward. If not, basically no one can use it if gas prices are like at 300 Gwei and each transaction costs like $10. Yeah.
Mm-hmm. Yeah, I mean, definitely the Ethereum network is being very congested, you know, due to the spectacular rise in DeFi. But you know, how, when you want to program and you want to develop, a smart contract and a DEX across multiple chains, how tough is that, with the differences between those different protocols? How tough is it to actually, develop a DEX for each one? Is it a simple copy, paste, and change some words, or is it a totally from bottom up new process?
I think it's if you're going to really build a smart contract that has a trading engine and a whole system on each smart contract, it's actually not so easy. And because actually you kind of need to understand how each blockchain actually performs and what are their little differences, their nuances. So especially because when a blockchain is just developed, sometimes it's not. It's at the Genesis block, not everything has been thought about, not everything has been engineered into the protocol. So you got to analyze it really carefully and making sure that what you build actually works properly. So it's a lot more. It's a lot about understanding how these systems works, how these protocols works, and then adapting what we are good at in terms of like building trading engines, building trading systems into that blockchain. So so it's not really a copy and paste thing. I mean, unless it's like a fork of the VM, meaning it's using the Ethereum VM and it's basically the same. You can use Solidity, but let's say Zilliqa, they're using a different VM altogether, a different language altogether. On EOS, you use C++. On Neo, you use C#. It's all different. The VMs are all different. Then it's a bit it's a bit more complex, a bit more in depth. And the experience that we actually keep is knowing what to look out for, understanding how these blockchains works, and that's why I think we are one of the few companies in the world that actually have experience looking at so many blockchains in depth. I think
that probably gives you an incredibly unique and in-depth point of view. In terms of the differences in the true nature of the different blockchain protocols. Most of us, our only experience with these blockchains is interacting with them, is trading on them, storing whatever we may be, however we may be interacting with them. But like you said, you're getting an under the hood look when you're developing on each of these blockchains. So maybe you could give us, some insights. What's the most, has that changed your point of view in terms of, of rankings of the blockchains once you got to see under the hood and see their technical abilities and specifications? So in your mind, what was the most surprising blockchain protocol in terms of how impressive it is as a protocol? And two, which is the hardest and easiest blockchain protocol to develop on that you've seen so far?
Right. It's an interesting question. So I think all of them have some pros and cons. I think Zilliqa using the Scilla language, sorry. It's interesting that in the way that they try to make everything very secure by being by actually not being Turing complete, but being almost completely functional. So a lot of things can be statically proven. It's easy to analyze flows and value, the flow of value basically. So that's one of the more interesting concepts I've seen recently. But I think in terms of blockchain system, I think Tendermint is actually one of the most exciting for us right now, because the way they engineered it was, and that's the reason why we are actually using it for our sidechain as well. The way they engineered it was very, very well thought about, in terms of like packaging a consensus layer and then letting you build whatever you want on top of it. So that makes the whole system very flexible and yet still very secure, because you aren't forced to write in a certain language and then execute your program in a virtual machine. Where there's a lot of where it's not so straightforward as compared to a standard piece of code that acts exactly like how it would or in a normal application. There's there's no compilation into a different sort of operation that's not clear to developers or engineers. So yeah.
So I mean, I find it very interesting. I find myself very lucky to be able to speak to you, because in a traditional, tech world where the technology is already so mature and advanced, what the way that innovation and development happens is that they see what the market wants and then they develop it. And with blockchain, where it's such a new technology, it's so young and it's so new that people are still, the way the development cycle works is that people don't know yet what they want, and developers are actually developing the products, and then the market comes. So I wanted to ask you, when you're choosing which blockchain to develop blockchain to develop your DEX on, because I'm sure it takes a tremendous amount of work and time and effort to actually develop it and make it compatible with a new blockchain. How does that process work? How do you choose the blockchain? Obviously, you're going to go to the ones first that people are using, because without volume, without liquidity, who cares? But let's say you have two blockchains to choose from that you could develop on next. One has a higher volume, but it's just way tougher to develop on and way tougher to integrate. And another one's easier to develop on, but it has less volume. And the reason I ask this is so that our viewers, who are mostly students around the world interested in blockchain, could kind of get an idea of how this technology progresses, because essentially developers like you are the ones who are dictating the future of blockchain.
Right. So it's an interesting question, and there's no straightforward answer. I think it's a weighing thing. It's between, so for example, to give you an example, the reason why we first built on Neo was because even though it's pretty new, we felt that it was easy enough to develop on, and for Neo itself, we had the first movers advantage. It became the first DEX that launched on Neo, and at that time they also had quite a lot of token projects going on the Neo blockchain, and they actually gave us a very, very strong and supportive user base when we launched on the Neo blockchain. So yeah, going forward, it turned out to be a pretty good choice, because they've been now they're going to upgrade to Neo 3, and there's a lot of new tech that they've been continuing to push forward. Mm-hmm. So I think yeah, you don't actually know, like you say, in the end what will happen. It's more of like looking at the blockchain, understanding the ecosystem, and then developing the best product that you think people will use. And if the product fit is right, then people will come. Yeah.
Mm-hmm. And like we mentioned before, it seems like this is now the time for DeFi and DEXs to shine. This is when people finally started to realize them and use them, and traffic and volume has skyrocketed. How do you guys differentiate yourselves as a DEX from other DEXs? Where when it comes to a centralized exchange, there kind of is a personality to it, because it's centralized. So you associate, this is the team, this is the interface, this is the story behind it, and this is how I want to interact with. But when you're a DEX, you're essentially, because you're decentralized, do you find it harder to differentiate yourself from other DEXs because you're missing this aspect of a centralized story or centralized idea?
I think a decentralized, I think even by being decentralized, you can have a very strong story as well. So we for us, it's always about breaking limits, right? We want to build finance without limits, and I think it's also something that resonates with a lot of people. So that's something we try to lean and follow as well. The other thing also, I think, is that this currently, at least, the users of decentralized exchanges are more cutting edge users. So the differentiating factor usually would be about the technology itself, and just by having this new idea or this new innovative feature or way to do things, then that actually resonates with a a lot of people, or at least our target market. Yeah.
And how do you guys onboard, more users? How do you guys go for adoption? Is it it's not putting an ad on Yahoo.com. It's an entirely new world. In the DEX world, how do DEXs chase after new customers?
I think besides the standard thing where you just you try to list popular projects and tokens. The other way, the other major way is really to join the conversation, to really integrate ourselves with the larger community, and it's not about hard selling it or pushing it. It's more like saying, hey, we have something interesting. It's kind of related to what you guys are talking about. Maybe it's something that worth looking at, and doing this continuously, consistently. That's, I think, how we make ourselves known. Yeah.
Mm-hmm. And when it comes to DEXs, one of the most important issues, or one of the the biggest factors, is liquidity. It's very tough. Once you have liquidity, it's easier to build liquidity. But how do you get that for initial liquidity when when there is no action on your DEX, you're just starting off? How do you get that first push over the hill to then get enough liquidity to actually attract traders?
So I think a lot of the most successful projects don't try to compete head on. They try to collaborate. So because it goes back to what I was saying just now about composability, especially if you're building on the layer one system, you need to look around at what has been built and what can be used and leveraged on, especially because smart contracts are generally very composable. They can interact with each other. So I think it's more about thinking how to leverage or make use of whatever's already there, whatever liquidity is already there. So to give an example for Switchio, we are actually integrated with a lot of liquidity pools like Uniswap, Kyber, and I think Balancer. And how this works is that our smart contract, which has the Switchio exchange smart contract, is actually able to tap on these other liquidity pools. And when there are no insufficient orders on Switchio exchange, the orders actually routed to the liquidity pool and traded in, say, Uniswap or Kyber, and then forwarded back to the user. And of course, there's certain off-chain kind of techniques that we do. We basically look at the Uniswap pool and then simulate these orders on the order book. So immediately you have like a very liquid sort of order book when the user first looks at your exchange, and that's something very powerful. And we always want to keep making use of that. Yeah.
Mm-hmm. Well, and was that a tough process integrating with these liquidity pools? Is it easier to integrate with the liquidity pool than to integrate with a blockchain protocol?
Yeah, I think integrating with liquidity pool it's easy if you so for us it's a bit more tricky because the way we are kind of the way we do it, it's like IDEX where there's sort of a side channel. So you deposit funds into the escrow contract, but we do not actually send trades onto the Ethereum blockchain directly. That's going to take it's going to take like a minute or so to confirm. So in order to have the same experience as a centralized exchange where trades are immediately executed, what we do is that we accept orders through signed messages on an off-chain server, and then this is then routed to this is then broadcast by Switchio itself onto the blockchain asynchronously. And this doesn't need to be so fast because the user doesn't actually see it. He only sees it when he's going to withdraw, and then he just waits for the transaction to go through. So it's more tricky for us because then when you want to use the layer one liquidity pools, you kind of need to ensure that even though you execute the trade immediately, it eventually still gets confirmed on the blockchain. Furthermore, because it's not just interacting directly with the contract, we actually need to simulate the orders. That takes a bit more engineering effort. So I guess it kind of depends. I would say on a whole, developing a whole thing on a whole new blockchain protocol definitely takes more time. If you can integrate with a a existing protocol, it's pretty fast. But if you want to do something special, then you kind of need to take there's a lot more engineering effort involved in making sure everything plays out correctly.
Mm-hmm. And because this is such a new technology, and everyone's kind of learning as we go along, including the developers like yourself, is there do you ever have a fear, and should users have a fear that, hey, this is so new, we're dealing with complex issues in smart contracts, that that there could be a big slip up, once you're going off chain? Is that a weak point in the security? Is that something that users should be worried about?
So I don't think it's so specifically regarding off-chain, I don't think that's a security issue. The only issue that could happen would be that your orders just don't get settled, and you just end up with the initial balance. Because at the end of the day, everything is still controlled, escrowed, and secured by the smart contracts. However, in terms of the general, like the larger scope of things, especially with smart contract platforms like Ethereum, where like I mentioned, it's compiled into opcodes that are executed on a virtual machine. You got to really, the developer really got to understand how it works, and really analyze every single line of code. If not, there's an opportunity for smart contract flaws, exploits, hacks, and it's exploits, not so much hacks, and due to loopholes in how the developer thought it will work versus how it actually does work. And I think we've seen it quite recently with YAM and a couple of other tokens. Like every couple of months, that there'll be one that had this sort of loophole. So yeah, I think the ways to solve it, of course, is through audits, and also as a developer really understanding how the protocol works at a very low level. Not just how the language works, but like how the virtual machine actually works, and how each contract actually interacts with each other. Yeah.
Mm-hmm. I mean, you mentioned audits. When someone's picking a DEX to interact with, how important is it that they look into the audit history that's gone under, it's undergone a rigorous amount of audits before launching? I mean, when you look at the bouncer hack, clearly it didn't seem like the audits helped very much. So are audits actually helpful in this space?
Well, so as a user, I think definitely audits will help somewhat, but I do think there's a lot of audit companies that are not up to standard, and I keep seeing them used, even though that they have shown that they're not, it's insufficient. So so choosing the audit company is one thing. The second thing is in terms of bug bounties. So actually, bug bounty campaigns are a lot more useful than audits, because basically a lot of these exploits were actually detected by white hackers or bug bounty hunters, and the way that they do things, because they are individuals who see things in a creative way, they are able to identify the loophole more than an audit company who just goes through a checklist of things that you should do or shouldn't do. So choosing the audit company, bug bounty programs, that's important. And of course, as a user, from the user's perspective, besides just looking at audits, it's more about how you want, how the popular way to look at contract security would be to look at how long it has been, multiplied by how much value is locked in the contract since the beginning, and that kind of gives you the sense of how secure it is, because the more money that is locked in for longer, and the fact that it hasn't already been exploited, means that it's probably more secure. Because the more value there is, the more reason there is for attackers to be looking at this contract. It's basically a permanent bug bounty program if they can actually exploit it. Yeah.
Now the switching gears a little bit, DEXs vary greatly, and with that, the degree of custody a DEX requires can vary greatly. In your view, where is that sweet spot, in terms of custody for DEXs?
So I think for DEXs, definitely the custody should be with the user, or basically like 100% of the time. The only difference would be in terms of like how certain things work. So for example, if you have a off-chain order matching, it just means that that the trades could be reordered, or the trades could be like withheld. But at the end of the day, if that happens, you can just withdraw the funds from the contract directly. So I think the key thing is that the user must always be able to exit the smart contract. So that's the first thing. Regarding how the trades are actually executed, that's less important, because once if the exchange actually does mess around the trades, it's very easily detectable, and then all users can just exit the smart contract. However, it's of course still more ideal to have everything truly decentralized and trustless, and that's one of the reasons for our sidechain actually. We actually, this off-chain order matching engine has actually moved on to this sidechain. So all the validators of this sidechain are actually doing the order matching using, like I mentioned before, the Tendermint blockchain as the Tendermint consensus as the underlying layer. So trades are then routed, instead of going to our off-chain API server, it's going to go to these validator nodes, and then the transactions will then go onto the layer 1 blockchain rather than coming from our off-chain API server. So it's a scale, and of course we always want to go for the most decentralized, the most trustless, and the most permissionless possible.
Mm-hmm. And going with this second layer and off-chain solution, how does that affect slippage for pricing when trading?
So I don't think that's much impact on slippage. Slippage is mainly about liquidity, and so what we actually want to do is to continue to use the layer 1 liquidity pools, and on top of that, we are developing native liquidity pools so that users do not have to basically pay the transaction cost of the Ethereum blockchain. They can do all their swapping, their pooling on the layer 2 blockchain directly. So the liquidity on layer 2 would definitely take some time to build up, and that's why we want the best of both worlds. We want to be able to use both layer 2 liquidity pools, as well as continue to tap on Uniswap or Kyber as a liquidity backstop.
And with this, continued interconnectedness in DeFi, where these liquidity pools are, being aggregated and put together, and if you could just code to kind of tap into all the liquidity pools at once, and it seems like we're going more and more in that direction. Do you believe that slippage is a thing of the past? If we could continuously just pool all our liquidity, in a DeFi interconnected way, is slippage a thing of the past? And until then, how important is it for a trader that a DEX could kind of has the ability to show the expected slippage on each trade?
I think I think liquidity pools can be improved still. I think Balancer has improved it somewhat, where you don't have to put exactly 50-50 of each asset. So the reason why I say it can be improved is that to actually have a very low slippage, you actually need a really huge liquidity pool, and this actually it's not very efficient use of capital. So the capital in the liquidity pools could be used for other purposes. The truth is that a lot of the liquidity is just locked up there for the sake of fulfilling the mathematical formula. So So I don't think just having larger and larger liquidity pools is the only solution. I think we need to look more into different types of bonding curves, meaning that the formula for for how the liquidity pool prices each trade. I think that can be optimized more. We can be more creative with that. I think Kyber also, I think recently Kyber did something similar to that, where they tried to play with the bonding curve such that the use of capital is more efficient. I don't think that liquidity pools at the end of the day will be the only a mechanism to give low slippage trades. At the end of the day, a market maker who understands the price of something will still be able to give a much better price even for a large volume, because he can place all his orders at a single level and then hedge it through some other means, through a derivative or otherwise. So at the end of the day, I think that there's still a space for manual traditional market makers, even in DeFi. Especially right now, it's hard to do it on layer 1 because the trades are expensive. But once you go to layer 2, I think that's when we'll see like the traditional market makers coming back, placing orders and competing against the liquidity pools and the automated market makers. Yeah.
Interesting. Now, right now, you know, DeFi is hot. DeFi is blowing up, and you're lucky to be part of that. But a lot of the haters are comparing DeFi right now to the ICO boom and ICO bubble of 2017, 2018. Do you think that's a fair comparison?
I think yes and no, in the sense that I do see a lot of projects that are really, or a lot of tokens that are really obviously just capitalizing on the hype, but then at the same time, a lot of new DeFi protocols, a lot of the interest is because that is proven to be a market fit. It's proven to work, and there are some actually, at least a portion of the activity is definitely genuine, and we can see growth in terms of block value, etc. So at the end of the day, I think if there are more projects that come along that are not fully legitimate, then eventually at the end of the day, it might be kind of the same thing where the actual useful and good projects will continue to survive after the hype dies down. Mm-hmm. So as a user or as a trader, I think it's important to really understand what you're going into, understand the project. If you are in just to write it up, then be very, very careful, I guess. Yeah.
Mm-hmm. Well, in response to the ICO boom and the crash, regulators around the world started cracking down on some of these projects, and that some of the worst ones. Is that even possible in DeFi? Is it even possible for regulators to get involved, to even regulate? I mean, how could they even regulate if they wanted to? Do you see DeFi as being a forever untouched and unregulated industry, or like everything else, will the government somehow be able to get their hands in and control it?
Yeah, that's an interesting point. And I do think it's actually way harder, especially with the way that things are being done right now. Previously, companies or projects would write a white paper, they put names behind it. So there's actually people to go after. There's actually a legal entity to shut down. But a lot of DeFi tokens, DeFi projects these days, they just come up with this concept, post it on a forum anonymously maybe, and then throw it on Uniswap, and that's their listing, right? And so that might be, it's probably impossible to shut down something like that. So I think as a community, as users ourselves, we must discourage this kind of way of doing things, and basically don't feed onto it. We should, I think even though I think a lot of people are interested in that to just ride the hype, but we should really be looking at improving the legitimate projects that are out there trying to really grow their user base. Yeah.
Mm-hmm. So before DEXs came along and really got popular, centralized exchanges kind of were on a spectrum. There were those that complied with full KYC, AML. We're open and very coordinated with regulators and governments. And hey, you know, if we're serious, we're respected, we're regulated, we're accredited even. And so the traders that wanted that could go to there. And then because there's a need for the other side, there were other centralized exchanges that were more lenient with KYC, more lenient with AML, or didn't require any at all. And so there was kind of this spectrum when it came to centralized exchanges. If, hey, I want to be public or more open with the governments about my trading, and then there were centralized exchanges that were less. With the rise of DEXs and where it's so much easier and there's so many more options and it's so much safer for a trader to trade anonymously, to trade without the KYC, without the AML, do you see that spectrum of centralized exchanges that historically have been anonymous going away, where now centralized exchanges will either have to, you know, target the fully compliant market or become a DEX themselves?
Yeah, I think that's pretty likely. I think likely if like the whole DeFi movement works out, there will basically only be two categories of exchanges. One where you deal with fiat gateways and therefore you're like fully compliant. But once it goes onto the blockchain and everything is interconnected, then there's no really good reason to use a shady exchange and take the counterparty risk anymore. So right now, the centralized exchanges, there's two key main benefits that they have. One is the first mover advantage, and so their user base is everything for them right now. And of course, the second thing would be the fiat gateways, because it's impossible or it's very hard to basically transfer something out of the blockchain, like something physical, onto the blockchain layers itself without some sort of third party, some sort of oracle, some sort of custodian. Maybe eventually you see someone tackling that, but right now it's still a very tricky problem, and that's why the DEXs have that advantage.
Well, that's a really, really interesting point that you just made, because that, in my view, that is the biggest hindrance to DeFi, is its reliance on centralized finance for onboarding fiat, for on-ramping those fiat ramps and off-ramps. I mean, is it even possible? Will we see a day where you could do fiat on-ramps and off-ramps in DeFi?
I think, yeah, so I think two things. One is we have seen that a lot of DeFi protocols are moving towards a sort of not fully on-chain. Like Uniswap is a very full on-chain sort of system. Everything's financial, so everything can be tracked on-chain itself, at least within the scope of the tokens that are on Uniswap. But we have been seeing a lot of new tokens, or a lot of new platforms that actually interact with the real world in many ways. So for example, in terms of, there's a few examples. So one of them is like Nexus Mutual. So it's an insurance sort of thing for DeFi. You insure smart contracts, and this actually relies a lot on governance, on the holders saying whether we reward this or not. Similarly for where they do uncollateralized lending. So it's not actually collateralized, but then they lend it out. And so actually, based on these principles, that it's not impossible that you could have a system where whether something is whether there's this USD being sent or being collateralized, that could be a sort of governance-based or community-based thing. I think there's been a few experiments on that, but haven't seen any that fully works yet. But I don't. It's definitely not impossible to construct a architecture or to have a solid game theory that allows this to happen. So I think that so I think that's the first thing.
Yeah, sorry, you continue. I mean, I don't want to forget. We're going to get to you mentioned insurance. I want to ask you about it, but continue with your answer. Sorry about that.
Right. Yeah. So I think that's the first thing. The second thing is also if you believe in terms of crypto being a world currency, there's also a very slight possibility that we may not need the fiat gateways so much in the future. if you can actually, if Bitcoin can actually be, let's say, a store of value, and you can wrap Bitcoin on Ethereum, then perhaps the USD aspect of it is not that important. Maybe 10, 20 years down the road. That's the other possibility. Yeah.
Well, that's the goal, and that's the utopia,
Yes.
and who knows, maybe with the development of CBDCs, once that happens, people and smart developers like you will figure out how to do atomic swaps with the government CBDC and things like that, and that really gets rid of the problem. I mean, there are pros and cons, because once government money goes on chain, you know, a lot of people think that blockchain is hidden money and for criminals, but in reality, Bitcoin is way easier to track than cash. You can't track cash, and Bitcoin you can track.
Right.
So it's really interesting that when it comes to CBDCs and government money goes on chain, there is a big fear that all of a sudden governments are going to be able to really track money. But on the plus side, it will potentially figure out a solution for this DeFi fiat on-ramp and off-ramp, because it will no longer be DeFi, but more of a decentralized or digital currency. But you did touch upon insurance, and I want to ask you a little bit about that, because up until now, the more popular instruments that we've been seeing in DeFi so far have been DEXs and liquidity pools and kind of trading of currencies. But you know, in my view, I really think that insurance it fits so nicely with this technology. Historically, insurance got its start when it was communal. It wasn't people going to big companies. Historically, insurance was a group of people coming together, pooling a little bit of money. So just in case one of them took a big loss, that he would take all the money and they would be protected. And we've kind of gone away from that. You know, and nowadays insurance, you go to a big company, you give them some money, they take huge fees. They always, when you want to cash it out, they always fight you, claiming that for whatever reason, your particular case doesn't fit under your thing. But with DEX, with DeFi, and with smart contracts, and its trustless system that enables, I really do see this as an amazing possibility where now parties that don't know each other, people that don't know each other, could build their own insurance pools and be covered, not have to trust each other, pay low fees because there's no big building and administration, and really open it up. In your view, is insurance a good avenue for DeFi? And you know, you're developing on these blockchains. How hard would it be to develop a real working comprehensive insurance protocol?
Yeah, so I think it's definitely possible, and I think that's actually probably the next step for a lot of these players. So, for example, Nexus Mutual right now, they only cover insurance for smart contracts exploits. But I think it's a very small step to basically build it out towards other things, real world issues, even insuring losses, plane tickets, etc. And so it's just about, so I think for DeFi, the reason why it's DeFi smart contract is because it's well known, it's within the same space. But I really hope that they will expand this into more things step by step. So yeah, I think a lot of these protocols are in fact in place already. It's about just getting the user base in, getting people to understand, of course, building the UX out, because this is something that nobody has ever built. No one has ever built underwriting for insurance, right? There's no such thing. You only buy insurance. You don't actually contribute to an insurance pool. So once all the infrastructure is out, I do think within the next year or so, you definitely see them insuring something other than DeFi smart contracts. Yeah.
And you know, last question before I let you go. There's a lot of students from universities around the world watching this who are interested in blockchain. And you know, you're working on the blockchain, and I don't know your background, but I'm assuming you have a pretty heavy background in coding. But when it comes to developing, you know, these advanced, you know, financial instruments, essentially, you know, you don't just need coding knowledge. You don't just need blockchain coding knowledge, but an idea of game theory and deep financial systems. So, what advice would you give to people, to all these students out there who are interested in blockchain, maybe learning about blockchain? What advice would you give to them that maybe some other fields that they should also learn about because they might need it when it comes to actually developing a blockchain that they didn't even think about?
Yeah, so like you said, definitely what financial knowledge, understanding financial systems, understanding game theory, these are the most important aspect because there's lots of mechanisms that require this from making sure that your system doesn't get DOS, doesn't get spam, to incentivizing different actors in your decentralized ecosystem. I think the key thing, of course, is blockchain technology is a cutting edge sort of technology, and there's like new things coming up every day. So at the end of the day, one of the reasons that I think blockchain developers also build things so quickly is because they have a very strong, they are able to pick up new concepts very quickly, and this is very, very important in terms of because you never know when it intersects with something else that it might be like for the traditional finance. Then you got to kind of understand the whole ecosystem, how that worked, and then to make sure that you don't make the same mistakes, and to make sure that what you're doing on in a new way makes sense. So that's the most important. The other thing is, of course, security. If you want to pinpoint something that should be on blockchain developers' mindset, it's always about security. It's about making sure not just the smart contract works, but in terms of the larger ecosystem, the loopholes that you don't know that you don't know, you got to just keep. That's the mindset that you need. That you're always looking for possible ways that the system could fail to work. And so it's not so much about security as in computer science security, but it's more in terms of having a security engineer's mindset. Yeah.
Mm-hmm. Well, Ivan, thank you so much for taking the time to explain to us a little bit about what goes on under the hood and behind the scenes of this really exciting new world of DeFi and DEXs. Thank you so much for taking the time. And for all our viewers at home for Reimagine 2020, I'm Yonah Hochhauser. Thanks a lot.